How you doing?
What's up? Busy day. How was the meetup?
Meetup was solid. Another good group of man. I just like how diverse it's been. Just between passive investors, active investors, vendors, good stuff.
It's great.
Yep, yep. And give it a few minutes. We got quite a bit of people jumping on right now.
Yeah, and then I'm putting us in the private Facebook group as well.
Yeah, I think what worked good last time too was tagging everyone.
You tagged
As much as
everyone?
yeah, as much as we say we don't like that, it
I was
seemed to
wondering.
work
I was
nice.
like, man, that they got a lot of views, more than usual. So
Yep. I think that's the first time I've used it in the group, but I hope people didn't hate me for it. Did you
yeah,
already
we're
put?
live.
We're okay.
We're live there.
So I'll tag that real quick too. That dark person in the shadow is Mina, if everybody's wondering.
Yeah, Mina's our new investor relations. We brought him on June 5th, I think, a couple weeks ago.
Hey, everybody.
Some of you guys have already talked to him. You're on here.
Yeah, so for everybody that's jumping on, we're gonna get started in about a minute or so.
Man, look at that property. That's a good looking property right there. I've ever seen one.
And just tagged everybody in the Facebook group. So probably get started when you're ready, Eric.
For being here tonight. We're excited to present to you this new opportunity. As Brian was saying, as you can see from this picture, this place is absolutely beautiful. Stoney Creek Highlands Apartments in Rapid City, South Dakota. For those of you that don't know about Rapid City in South Dakota, be prepared to be impressed and kind of shocked as to the reasons why we're investing in South Dakota. We're excited. It's kind of one of these hidden gem markets that a lot of people don't know about. This market is experiencing growth, better than some of the top performing markets in the country, and you just don't hear about this place. So we're super excited to be here. 278 units. Just a quick disclosure. This is a 506c offering, so you need to be an accredited investor. So we'll be going through all that stuff tonight. So let's go on to, actually, how do I switch slides here?
I got control.
Okay, cool, perfect. So we're going to kick it off with a little bit about us, the sponsor team, and some of our case studies. For those of you that don't know us, obviously Elevate Commercial Investment Group. My name is Eric Badiwala. I'm the co-founder and COO of the team. So we got George here, myself, Brian, Justin, Nina as well, Joel, Tessa, and Michael Davilo. So together we're the ones that put together this entire deal from start to finish. It's definitely a team effort in order to get everything accomplished and get this taken down. So a little bit about Elevate. We're located in Dallas, Texas. We started in the multifamily space a little over 5 years ago. Been I think combined experiences easily over 30 or maybe even 50 years here. I'm not sure, but over the last 5 years, we've acquired about 6,000 units, in 7 different states, sold about 1,600 units. And we currently have about $450 million of properties under management. Lots of equity raised. This one here will be a big equity raise as well, just because it's a nice asset. And then our average IRR is about 47.5% with the deals that we've done. So it took a while to put together this team, but we feel like we have a rock star team. Everybody works hard here, and we're here to work for you and for our investors. So that's us. As far as Elevate, you can always find more info about us at elevatecig.com. So one of the things that we've been working on since our inception is growing and trying to excel in many different ways where we can bring more value to our deals, our investors, and our partners, right? So it's not only Elevate Commercial Investment Group. We recently opened up our management company, which is Elevate Real Estate Management, and that's who we're going to be using to manage the property. That's head up by Michael Davalos, who's the CEO of Elevate REM, and our COO, Tessa Frank. Tessa actually lives in Rapid City. She's a native of Rapid City. She actually lives right behind the property. She could throw a rock, to the property. So she's real close. So that's great that we have, local boots on the ground. And we're excited about it. We started Elevate Real Estate Management last year. We've been taking over assets in the Texas area and in South Dakota. And we're continuing to expand in both of those markets and other markets as well. And then, of course, we have J&T Construction, which is led by George. And, it helps us keep everything in-house and manage construction, from A to Z. J&T has done ground-up development, has done a ton of multifamily, and we work with them hand in hand to be able to execute on our CapEx. It just allows us to control everything a little bit better. We've all had, third-party management nightmares, and we're trying just to have more control of the way we execute moving forward. It allows us to be consistent, obviously cost savings and a ton of other benefits. So that's us as a whole, and we're excited about launching our vertically integrated operations and just announcing with everybody, because really not everybody knows about it yet. This has been years of work putting this together, and Elevate REM was that final piece. So excited for it. So a lot of you may not know South Dakota, but we've known it for a couple of years now. This is going to be our second asset in Rapid City. We actually own in Sioux Falls as well. So we bought La Crosse Estates. It's really a Class C asset. We bought that in early 2021. Purchase price was about $98,000 a door. As you can see here in the slide, average rent January 2021 was $812, and as of this year, $937. The great thing about Rapid City is that the supply is very low, right, and demand is incredibly high. I don't know any other market where I think the average occupancy is about 97%. At La Crosse, we're 99% occupied, and that's been, a very solid trend since we've owned it. So it's just incredible. Most markets you try to underwrite for, 7 to 10% vacancy at least. and here it's even hard to do that because the occupancy is so strong. And any building you go visit in this Rapid City area is full. And they have seriously long wait lists, right? So number one, that's one reason why we like this market, right? Is the demand is super high, supply is super low, and everything stays full. And there's a long wait list, right? So that's great. And then people pay their bills here. This is a market that, and I think I may be jumping ahead here, but this is a market during like COVID that did not shut down. People were working, they were going to work, no masks. It's a very red state. And people pay their bills. They're serious about it. They want to know what expenses they're covering. And they're very on top of it, right? Which leads to very low delinquency. So at La Crosse, we had 1% delinquency over the last 2 years, which is great. I think on a lot of our assets, we always aim for, under 5%. But to have, 1% delinquency is really a grand slam and a win for us. So excited about that. So La Crosse isn't very far from Stoney Creek Apartments. It's about 16-minute drive, 10 miles. La Crosse is in, like I said, a C-class type of neighborhood. But Stoney Creek is, obviously an A-class property. So we're excited. We're excited to increase our footprint in Rapid City and continue expanding our portfolio there. So the next slide, Brian. So the most exciting thing about what we've been doing in South Dakota was one of our recent wins, which was Sioux Falls. I just talked about it. So in May, so what was that? I guess last month, we were able to refi and return 82% of our investor capital was returned at the refi, right? So that's not something that we expected. We always hoped that we would. We were gonna, as you buy deals, game plans kind of change, but a refi was in the game plan. We just didn't know we were going to return this much capital. So 82% of the capital was returned, and we feel that was a huge win, right? We have been distributing on those deals, which is also a win for us, especially in the economic environment that we're in. But we acquired that deal in 2020. We bought it for $63,000 a door. Rent was at $720. They're currently at about $762, and again, low delinquency, right? Sioux Falls is a little bit different, so the delinquency is a little bit higher, but you still can't beat 2.5%. And then obviously occupancy, Sioux Falls, in Sioux Falls, the occupancy isn't as high as Rapid City, but still very solid, right? I think the average is probably about 95% there. So again, expanding our footprint. Woodlake Apartments is another C-class asset that we have, in South Dakota. So just great numbers overall. I mean, it's super exciting when you can go to a market and you don't have to work extremely hard to collect rent and to drive occupancy. It's almost automatic in these types of markets, which a lot of people don't know about it, right? Every time we tell people, hey, we're taking a trip to South Dakota, they're like, what? Where's that? Why? And then when we start talking about some of the numbers and some of the reasons, some of the driving factors, which we're going to talk about all tonight, it really sparks interest, so this is really one of those under the radar markets that we like, and we were lucky enough to come across a couple of years ago, and we've decided to expand our footprint. So that's it for some of our case studies. What do we got next? Oh, okay. So now we're going to pass it over to George, I believe, right?
Yeah, that's correct.
Yeah, so he's going to kick off with some of the investment overview, and then we'll be passing it on to the rest of our team, and hopefully, you guys will like what we have here tonight, but super excited to present this. So George, take it away.
Yeah. So, once again, welcome all of you for joining us this evening. Like Eric mentioned, we're all really excited to be presenting this offer to you, our latest acquisition, which is Stoney Creek Highlands. So I'm going to quickly go over the property. I'm going to show you how you can invest and what the returns will also look like. So quick summary here, about the property and the location. We'll go into more detail on all of this as we go through the slides, but one second, let me move some stuff around here. Okay. So first thing I want to point out is, look, when we first mentioned South Dakota, not everybody's super familiar with it. A lot of people do know Mount Rushmore, so that's the picture you see there in the background. That's where Mount Rushmore is located, is Rapid City, South Dakota. And the amount of population growth that has been going on here, been a sleeper market. But when you look at these numbers, so 2.47% has been the annual growth. The national average is 0.38%. So that's about 7 times the average of what's been happening here in South Dakota, which you can see there, 7.58% since the most recent census. So one, we like the market. We like the market a lot. Like Eric mentioned, we're familiar with it. We've had success there already. And then this deal specifically we like because one, it's a nice looking A-class deal. And two, there's a very clear value add opportunity for us to come in and immediately raise the rents up to market without even having to do anything. And then we'll go into more detail on that as well, where there's also some premium rents we can get. But on top of that, from day one, this deal will be cash flowing. So those are the main reasons why we like it. On the next slide, Brian, if you can. Yeah, so this is, I'm just going to give you a quick summary here of the deal and also of what it looks like as far as investor returns. So, as far as the deal, it's an A-class deal, like I mentioned, built in 2008. Same developers that built it is who we're buying it from. It's 278 units. So purchase price is 46.7 million. The hold period that we're projecting is from 5 to 7 years. And we are raising 19.2 million, which as of today, we're right about 75% subscribed. So this has been moving fairly quickly on the subscriptions. We haven't had this out very long. It's just been a few weeks. This is the first webinar we do for accredited investors. So yeah, we don't expect this to last much longer. As far as projected returns for our investors, we're looking at an average cash on cash of 4 to 5% with an average IRR, so internal rate of return of 15 to 16%, and then an equity multiple of 2 to 2.55x. We always try to pretty much 2x our investors' money. So with this one going from 2 to 2.5, one of the reasons we're very excited to be able to present this to our investors. If you go to the next slide there. Okay, so we have 2 different class shares. If you want to invest, you got a class A1 and a class A2. The difference there is the minimums. So for class A1, which is option 1, it's a $100,000 investment is the minimum. And what you get for that is an 8% preferred return. So pretty strong preferred return there with a 70-30 split and one hurdle at 16% IRR where it goes to a 50-50 split. The investors get the 70 there, GPs get the 30, and then on the hurdle it goes 50-50. Now, the other option, so the A2 share, which is the minimum is 500K, you get a 10% preferred return, and the split changes to a 75-25, and the hurdle stays the same. So that's why you see some ranges here. Obviously, the more you go for the class A2, then the returns are a little bit higher. Go to the next one there. So here's a little bit more on why we love this deal and why we're excited here to present this to you. So one, we found this deal completely off market. Like we mentioned, it was same developer. Actually, I'm not sure if Eric mentioned that, but so one, we're buying it straight from the developer. So the property's never been sold before. And it's the same developer that we actually purchased our other deal in Rapid City from. So we're familiar with him. We know how he manages his properties. and we weren't competing with anybody. Second thing is the growth potential that I talked about, right? The city itself is experiencing a ton of growth. And then the fact that it's currently rents where we know we can easily come in and get these higher rents. And I say we know because one of the things we did when we negotiated our PSA with the seller is we are getting these rents. We're having him get these rents on renewals. So every renewal, the entire time we've had it under contract, the seller has been implementing our business plan essentially. We've done this before and been very successful with it, where we essentially just get the seller to start implementing our business plan. So when we close, we already got a head start. Path of progress, I already spoke about that quite a bit, and you'll hear more about it. But like I mentioned, Rapid City has got a lot of good fundamentals, a lot of growth, and it's off the radar. Hence why we've been able to come in at a pretty low basis for a deal like this. And then the low risk debt. So we're going in with a agency fixed loan. The Fed raising rates or what's going to happen with the rates moving forward, that's not going to be a concern for us. Come in, fixed agency, long-term debt, which lowers the risk. Go to the next one, Brian.
Actually, George, I wanted to add something real quick. You talked about,
Sure.
Buying directly from the developer, and, it's become a niche of ours, right? We bought our deal in Arkansas, Northwest Arkansas, straight from the developer. We bought a deal in Houston, straight from the developer. And then this is our second deal here in South Dakota, buying direct from the developer. But this was actually a legacy property for them. They never intended to sell this deal, and they wanted to keep it in their family. And what does that mean usually, right? Usually legacy properties, when you keep them in the family, they have to maintain pretty conservative because they never want occupancy to drop, right? Here it's, kind of a catch-22 because, demand is so high and occupancy is so high. But, and George kind of alluded to it and talked about it, is that rents were, low. They weren't really increasing or pushing rents. And I'm not sure who convinced them to sell. I think there was a family change, and they changed and they decided to sell. We were able to come in off market. So just another plus. We're always looking for like these off the radar, off the market type of deals where we can come in and take advantage of these opportunities where not necessarily you would if it was on the market, right? So I think that's huge, right? Not only are we buying from the developer, but it was going to be one of their legacy properties. They treated this thing like their baby. I mean, there's no deferred maintenance on here. And we'll talk about all this stuff in more detail, but I wanted to point that out because I think it's important, right? A lot of people say, well, how'd you find the deal? Well, that's how we found the deal. We found it directly from the developer. And not only that, this is like their crown jewel of their property. It's their last one. They were never going to sell it. So anyway, I just wanted to add that because I think that's important.
Yeah, no, that's a good point, Eric. You touched on occupancy, Brian. If you can go to the next, man, these are one of the stats that really stood out to me. But so for the last 2 years, the physical occupancy has been at 99.45%. I mean, that's unheard of. All the deals that I've looked at throughout the years, pretty sure I've never seen that. And the bad debt. So, looking at that number, you may say to yourself, well, there might be some delinquency or some bad debt in there. And no, I mean, the bad debt, 0.5%, pretty much nothing. So those are some pretty strong numbers. I will also mention that, sometimes when we're looking at deals like this, some of the things we get from the seller are we got to piece things together, and some of the reporting isn't great. What we got from this developer on this deal is it's the best package I've ever seen. I mean, he took note of everything. The CapEx that he spent every year was very detailed. We've got all the historicals. We know exactly how this property's been performing, which made it even that much easier for us to do our due diligence and feel confident in our assumptions. Go to the next one, Brian. So to quickly touch base on I talked about the fixed interest rate debt already, which is huge plus. Saw a question come through quickly, which we'll start addressing those. But the rate we decided to go with a Freddie agency loan. We haven't locked in the rate just yet, but it's going to be somewhere in the 5.4 to 5.5%, which is still a solid interest rate. It's maybe not the 2 or 3% we were seeing before, but I mean that's still a pretty solid rate. And just to give you more on that less risk I was talking about, right? By going in with this type of debt, our break-even occupancy is somewhere in the 60% range, which means that this property's been historically at 99%. Would have to drop all the way down to 60s for us to not be able to cover the debt payment. And then the DSCR, so the debt service coverage ratio, is at a 1.65 in year one, and then it continues to grow and grow and grow every year, up to 2 point. I forgot exactly what it is, but those two things right there show you much less risk in this deal because of that. Go to the next one, Brian. And then another reason why this is a less riskier deal is it's already a great looking asset, right? We're not having to do major renovations. We've got, which you'll see here in the next couple slides, we've got $1 million in CapEx, and most of that is going to some simple upgrades in the interior units and the amenities. Nothing major really. So that makes the value add component of this very easy and less risky. Next one, Brian. Actually here, yeah. So here's the CapEx I just mentioned, right? So we've got $1 million that we're going to put into CapEx. Got the breakdown there. Like I mentioned, it's mainly, see the blue on the pie chart there. That's the interior units. So a little bit more than half of it's going towards upgrading on the interior units. And then the rest is kind of split between the amenities and some of the exteriors. Our business plan in general is one, like I mentioned, we're going to raise those rents. So as soon as even before we close on the property, we're already having the seller raise the rents. But when we take over, obviously we'll be a little more aggressive with that. And then we're also going to be doing these unit upgrades. So not only will we make this $150 to $200 gap in rents of the market rents, we'll also have premiums that we'll be putting on the upgraded units. We're going to work on the curb appeal. There's some balconies that could be restained, and also some pergolas throughout the property. So we're going to restain that, and then we're going to do some new signage. And then we're also, on top of making up the rents, the loss to lease and the rents, we're also going to add other income that we've already seen work at other properties and comparables. So we're going to be adding internet, which at this point, I believe we've added this on pretty much our entire portfolio. It's easy to implement, and the profits are pretty good. And then we'll also be adding carports and renting those out. And then the last thing is renovating the amenities and the office space, and really, which you'll see here in a second. I mean, they're nice already. We're literally just going to take it to the next level and give it, another pop. We're going to add there's a volleyball court that doesn't really get used, so we're going to turn that into a pickleball court. We're going to add new pool furniture, new furniture in the leasing office. So yeah, just give it that extra pop.
Yeah, I'll add something there, George. I mean, I absolutely love these types of assets because it's like, it's already really good looking. I mean, you guys saw the picture on the previous picture, right? I mean, that's a unit that's in pretty good shape. I mean, I remember when Brian and I were over there doing due diligence. I mean, I walked in and I was super impressed. And what the current seller is doing now is just literally just putting in stainless steel appliances and calling that an upgraded unit, and they're getting, they're getting premiums for that, right? So we decided, okay, well, we can have two levels of upgrades, right? We can put in stainless steel appliances, continue that, but we can also take it to the next level, paint the cabinets, make it look a little more modern, take off those farmhouse animals that you saw in the previous pictures. Nobody wants to see that, right? So, you know, and then our thought is always being in tune with, you know, the tenant base. What do they want? What do they want to see? How do we improve the quality of their life there, right? You know, like George mentioned, that volleyball court, nobody uses it. We asked the staff there and it said, yeah, nobody plays there, right? And then pickleball is a huge thing now, right? People are doing it in business and in personal life. I've actually played a couple times myself and it's super fun, right? So, you know, putting that in there, people will pay more just because you have a better amenity package. And, you know, we haven't talked about the comps yet, but most of the comps in the area don't even compare when it comes to an amenity package here. So, you know, we're excited about the renovations. They're easy, you know, and it'll really take this property to the next level. And obviously you can see all the, you know, pictures here, but they're pretty nice. But, you know, there's certain things that we would change. And sorry if I'm stealing your thunder here, George, I guess change the slide, but like in the fitness center, you know, like that orange right there that you see on that AC unit. Like I remember when Brian and I walked in, we're like, man, what the heck is up with this orange? So it's just changing those types of things and adding a little bit more of a homier feel. You know, the dog park was kind of lacking. You know, I think our idea is to put turf down there, right? The grass was all messed up, right? And those are things that people, they're just wow factors, right? Where people will come in and say, wow, you know, like these people really show pride of ownership here. I really want to live here. You know, if you turf that, it's going to make a difference, you know, especially with the weather here in South Dakota. The weather can be beautiful, but it can also be, you know, a little bit more rough in the winter. You know, adding cabanas to the pool, like George mentioned, the pool furniture. I mean, the pool was kind of like plain, right? And I remember when we were there was a couple of guys that were actually panning out. I'm like, man, they would love it if there was a cabana there. So anyway, just excited to, you know, spruce up this place and elevate the quality of life for all these residents. So sorry, George, I don't know if you had anything else here, but.
No, you definitely stole my thunder on that slide. Yeah, so, you know, I don't even know if I can say more. Looking at the amenities, you know, they look decent, right? Yeah. But like Eric was saying, you know, we're just gonna give it that extra oomph to it. So when you tour the property, you're like, yes, this is where I want to live, which honestly, you already get that with the location of it, which I guess, let me not steal the thunder there, but yeah, we'll go over the actual location of this property and where it sits. And I think the next slide is going to be yours, Brian. So, you know, speaking of the market and where it sits, I'm going to go ahead and hand it over to Brian.
Yeah, appreciate it. And one more point on the amenities. If you can kind of see behind this market overview page, this property sits on 27.5 acres. I don't know that we brought that up yet. So it's pretty, like it's a 2008 build. You can put 2000, we toured, Eric and I toured other, you know, 2018, 2013 comparables, and they just didn't show as well because of how this developer positioned him when he bought this property in 2008. And he's held it since then. He positioned himself really nicely in this market on top of a hill. You can see the Black Hills, and it's a really nice property that shows really well. So it's a really nice stronghold to come into a market and sit on 27.5 acres, and you have 278 units on that. So it's a really cool feel to the apartment. So yeah, I'm gonna be diving into the market that we're investing in here. You know, something important too before we dive in is, you know, when you're looking at a new market to invest in, you want to make sure someone there has established, the person that you're investing with has an established track record. And that's exactly what Elevate did 2.5 years ago with the purchase of La Crosse, who we bought from the same developer. And we've shown the performance on that property, our Sioux Falls property, both performing exceptionally well. This property in particular performing super well. And I think why this market is doing what it is will kind of tell to the story too on the apartment. So Midwest is the best. So Stoney Creek is in Rapid City, South Dakota. You can see that right here in South Dakota. I was actually born and raised in Cincinnati, so I'm right here at the bottom of this Midwest area. So we're seeing a lot of growth in the Midwest. I think a lot of people here, Texas, Florida, seeing a lot of net migration, but within the Midwest, South Dakota is seeing a huge boom from the Minneapolis is from the Chicago's. So a lot of people are looking at Rapid City to grow. So a real cool stat here. The Midwest is the only region in the nation still sustaining rent growth, with most major markets continuing to push rental rates. So very stable market. You don't see a lot of huge swings in the Midwest. So I think, now more than ever, preservation of capital is super important. Right here we have kind of focally positioned Denver, Omaha, Minneapolis, all direct flights here to Rapid City. There's actually more and more direct flights being added to Rapid City. So that's always a good sign of growth. Our preferred equity partner, that was one of their requirements. They wanted to make sure they had easy access there. So George and Eric actually have direct flights to Rapid City. They'll both be flying in. We're all going again on Monday night and Tuesday of next week, doing another overview of the property, walking it with one of our preferred equity partners there. So these are really cool stats about South Dakota and Rapid City in particular. So South Dakota, if you know the governor there, it really is kicking butt the past couple of years. They didn't shut down during COVID. And I think that got a lot of, and now that what we know about it, it got a lot of eyes, particularly businesses looking at places in South Dakota. So if you look at your business and you want to move to South Dakota, Rapid City is probably the best place to move to open your business there. So that really protects businesses there. You can see not only that, but best business climate in the US, you see these other stats, top 100 best places to live, Rapid City was. So employer growth is huge, but population growth is big too, because employers bring in population, but having a good place to live keeps the residents there. So someone might go work for a company for a year or three, but when it's actually a good place to live, not just some big city that doesn't have really much to offer, but besides a bunch of places to eat, people end up staying there and retiring there and contributing back more into the local economy. You can see all these tops right here. Super important to have that when you're looking at a city like Rapid City. It's about 150,000 population, and that's really growing. Right here you can see 151,407 on the MSA. Unemployment rate was at 1.9%. That was actually a US record low. So this report came out in February. That's the lowest in US history. You can see a lot of local economic growth come into this city. Eric and I actually met with the business development center of Rapid City. They're also known as Elevate Rapid City. You can find some really good information on the city, elevaterapidcity.com. And they're very adamant about attracting new business into the area. They just built a $17 million facility. It's actually right next to Rapid City, right next to Stoney Creek. Here are some notable numbers. This is, super important when you're looking at A-class properties like this. Rental vacancy 1% to 2%. That's virtually, we can't even underwrite for that. The rental vacancy in the area is 1%. The property has performed less than 1%. In our underwriting, we have 5% vacancy, which Justin will dive more into. Right here, you can see population increase growth. So some really cool numbers on Rapid City.
Hey, Brian, can I highlight something real quick?
Yeah.
You said unemployment rate 1.9%. That was a record in the United States. I mean, hello, that's why we're investing here, right? Like, those are the things that trigger you and say, holy cow, we need to go over there, right? Like, nobody in the country has a lower unemployment rate than Rapid City, South Dakota. What does that tell you? It tells you that it's booming here, right? It's growing tremendously. Businesses are investing here, right? So when people ask me, why are you investing in South Dakota, right? These are the reasons, right? These are the reasons right here. And I want to make sure we emphasize it because we talked about a lot here, but I mean, in multifamily, when you say, what are the major economic driving factors? I mean, these are the things that we were looking for, right? So this is why we're so excited about this opportunity, because the numbers here beat any city and any market in the country. Anyway, I just wanted to point that out.
Yeah, it's great information. Yeah, exactly. So it's 7 times faster population growth than the national average. It's fastest growing metro in the Midwest, and there's some strong markets in the Midwest. To say that Rapid City is the strongest, fastest growing within the Midwest is a super important stat. 7 times faster. So we really like that we're coming in, on the upswing of this market. So this business plan is a 5 to 7 year business plan, and we're positioning to sell to an institutional buyer. There's already a lot of institutional interest in Rapid City, but as this continues to grow, we think that it'll be really prime for an institutional buyer to exit from. So that's, when you're looking at multiple exits and looking at your business plan, yes, it's great to have good numbers going in, but you also want to forecast where are we sitting when we're about to sell this property. So Rapid City is getting incredibly a lot of good numbers like this. So this is getting more and more institutional eyes look. So this is kind of the numbers you want to see when you're positioning for a 5-7 year business plan. So right here grew by 2.5%, while the national average is 0.35%. CoStar put out a really interesting report about a ton of net migration leaving Chicago, and Rapid City actually having the highest growth within those areas. So really cool stats here. 7 times fastest population growth in the national average. So really cool stat.
I will say, sorry on that.
Yeah, go ahead.
Just really quick. I mean, I'm constantly looking at population growth in different markets. I just want to mention that is the craziest chart I've seen, all the different locations. Just the fact that it's shooting up like that, obviously a good sign.
Yeah. So what are part of the driving factors? Obviously, it is we talked about how business friendly it is. Rapid City is one of the best places to live. So you add the combination of being super business friendly with actually a place you would enjoy living. You have an incredible mix to have really good growth. And these are the largest employers here. Obviously, Mount Rushmore, you might know Mount Rushmore, that's in Rapid City. So I actually went to Mount Rushmore for my first time last month when I went and visited the property. So tourism has a pretty good sizable footprint on employees. Walmart, who's headquartered here in Northwest Arkansas, where I sit, they actually have a big presence here in Rapid City. So that's a company that does a lot of market analytics. These companies are Walmart just pulled out of San Francisco and some other markets. So, but they're actually increasing their footprint. I saw the new one in Rapid City and it looks incredible. Ellsworth Air Force Base, I'll go more into that in a second. Monument Health, if you drive around there, you see a lot of private healthcare facilities. So you have, high income earners that want better healthcare there. So you have that. State of South Dakota, multiple healthcare here. Black Hills Corporation, that's who I pay my energy bill here in Northwest Arkansas. The Black Hills Corporation, it's a really cool facility. It's actually about a mile from Stoney Creek. So you're getting a lot of corporate white collar workers at Stoney Creek that are, fairly close to where they work. And, a huge factor, what we saw is Ellsworth Air Force Base. So Ellsworth Air Force Base is North Rapid City. And at the end of, I want to say 2021 or 2022, they signed on the B-21 stealth bomber. So if you're going to fly this B-21 stealth bomber, you have to come and train in Rapid City in order to be able to fly that. So they're expecting that economic impact to be $1 billion within the next 20 years. So they're going to the Air Force Base. Those Air Force bases are going out into the Rapid City economy and, putting a ton of money into the area. So it's a really cool, another really cool aspect about the local economy here. This is the last slide I've got right here, guys. I don't know if you had anything else to add, but so this is really cool information. I'll put some more information in the chat that you guys can look at. But we're really excited to be in this market.
Yeah, Brian, you talked about how we met the guys at Elevate Rapid City, which is the economic development team there. And I don't know if we expected to hear all the good things that they were saying, right? Like we were pretty impressed. But what I liked the most, their president there, he actually came from Colorado to start growing, Rapid City. And, the passion that these guys have to grow this city was incredible, right? You look at, and those are the things that I look at, right? Like, am I going to invest in a city? Am I going to bring investors to a city where the guy leading the pack is lazy, not motivated, doesn't speak well? No, this guy had the sharpest team come into the meeting that we were impressed, right? They gave us all this great information. They're the ones that told us about the stealth bomber. And those are the things that stand out, right? So those guys were passionate. He was talking to us and we're sitting in the office and he's like, man, we have to, how much was that building, Brian? Like $30 million that they had there? I mean,
yeah, it was, $17 million building just for the Economic Development Center.
Yeah, so it was a super nice building. And he was talking about how he wants to make right there where the Elevate Rapid City building is like the center piece to make Rapid City more of like a downtown where they have retail and office space. He's actually trying to buy the post office across the street because they see the growth that is happening, but in order to do that, they need to make certain strategic moves so that they can attract more and more people. Obviously, the people are coming, the businesses are coming, but the passion that we saw behind, this economic development team and how much they were excited about us continuing to bring more money into the city, was really exciting, right? It's almost like you have a good partnership, right? Somewhere where we know that we're going to get support from the city if, things go sideways or whatnot, and not that things are going to go sideways, but you never know. But this is a very strong market where, you have the support of the local, council and economy. And, so I just wanted to point that out. Those are, I've been to other cities before and, you're not really getting, that oomph from them and a feeling that they're really trying to drive this city forward. There's a lot of exciting things to be there. And, the guy came from Colorado to grow this. I think he was actually one of the integral parts in Colorado growing as fast as they have. And he reached a point where it was like, well, Colorado's grown this much. I need to take, quoting LeBron James here, but I got to take my talents over to Rapid City, South Dakota, and continue to grow there. So anyway, I just wanted to point that out. That's something that stood out to me. So again, excited to partner with those guys and great things all the way around here in Rapid City.
Yeah, you get a great feeling in the city. It's a really cool. There's a lot of good energy there, and we're really excited to be. That's one thing. A great place to live, fun place to live. The Black Hills and clean area. But it's another thing to actually look at the data that we presented here and the growth numbers and the business numbers. So that's what's really important in making an investment like that. And speaking of the numbers, we're going to actually have Justin dive into those, one of the more important factors when looking at a property like this to invest in.
Yeah, thanks, Brian. So we can go to the next slide here and just kind of show you where the in-place rents are at the property and where we, are pretty confident they can go. This graph to the right is coming from a third-party data source called CoStar, which is, one of the largest third-party data sources for commercial real estate. So at the bottom, you can kind of see where the in-place rents are at the property. And then, we're pretty confident there's like a $200 gap of where rents are in the market and where they can go. So going on to the next slide, we can see in the top there is where the for the most recent rent roll we have, how the rents have grown since we've been under contract. This has been a strategy we've done on a few different past acquisitions where we actually negotiate, with the seller while we're under contract to start raising these rents up to market. So before we even close, the property is increasing the market rates. The value of the property is increasing by closing. So you can kind of see at the very bottom where the in-place rents are for each unit type and where the average market rent that we want them to go to. So as you can see, like there's already several floor plans that we're achieving at or above our pro forma numbers already. So, really confident in this business plan, this strategy, just showing that this is a, proof of concept already. And this is a really important graph you want to look at for any deal you invest in. It's basically just showing that the current tenant base in this market can afford these rents. So any real estate operator, any property management company, they want to see at least a 3x of tenants making 3 times the rent amount. So for example, the average lease rent currently is around $11.98. Based on what the tenants are making in this area, it's 6.5 times what their average rent is. So as these rents go up to market rate, and even by year 5, you can clearly see kind of like the bottom number there, it's almost to a 5x. So, based on the median household income of 93,000, these tenants can clearly afford that the rents we're going after here. And going on to the next slide, just some very simple numbers about our acquisition numbers and disposition numbers in year 7. So we're buying this at just under 47 million, planning to exit at a 5.75 cap rate in year 7, and some sponsor fees down below.
Yeah, I think
Next
that's
slide.
super
go ahead,
important to
Rob.
look at. Yeah, just this cap rate, this is a big portion of the valuation. And when we were first looking at this deal, we were even thinking about underwriting it to a 5.6 cap rate, just to be what we thought was in line with where we thought this would be in 5-7 years. So we think 5.75 is even more conservative given where it is and where it's going.
Yeah, and this just gives you like a simple breakdown of proposed loan amount, preferred equity, and then how much we're raising from investors. Again, our purchase price, CapEx budget. Just give you a good breakdown of what we're looking at here for the capital stack. Next slide. Already spoke on the fixed rate debt, but we're expecting the interest rate to be settled down around 5.5 range. This is a 7-year interest only loan for 7 years, and preferred equity terms. Let us know if you have any questions on that to the right. Next slide you can go to. Very simple year 1 through year 7 breakdown of our pro forma. Really not a whole lot is changing just because this is already a stabilized property, kind of just needs some TLC and some updates. So operationally, there's not a lot of major changes, but we're bringing rents up to market. We're doing the internet package. So you will see some jumps just in the gross potential rent and the other income. You'll see a tax increase that we're proposing as well. All of this is available in our underwriting model. If anybody wants that underwriting model to go through yourself or ask questions about any of our assumptions, just get in contact with us. We can share this underwriting model with anybody. Some simple stress tests, like George was saying a few slides back. Really healthy DSCR. Basically just saying how much income we're producing on the property, and we can pay 1.5 times that and still cover our debt service. Very similar to the break-even occupancy. The property can drop down into the low 70s and going down to the 60% range, and we can still cover all the operational expenses. and the debt service for the property. So very healthy margin in that as well. And some different sale comparables. Stoney Creek is being purchased for 168 a door, which is below several recent sales comps. So we feel like I have a really good basis going in for the property. And now I'll kick it off to Ryan, I believe.
Yeah, I'll take it from here real quick.
Okay.
Thank you, Justin. That was really good, especially that last slide, the 168,000 per unit. And like I mentioned before, it's a great low basis for a deal like this. So real quick, just want to go over, what this looks like for you as an investor. So what you have here is an example investment. So like I mentioned, we got two different class shares. So if you were to invest, let's say 100,000, that's the first example we have here, you'd be looking at close to about 5% cash on cash with a 15% IRR, and then the equity multiple of 2.55. So, to simplify that, if you were to invest 100,000, you'd be getting back throughout the life of the deal 255,000. And that's between quarterly distributions, or if we have a refinance cash out or a sale, buying all those funds together, it would be around 255,000 is what we're projecting. And then if you were to do 500,000, be on the other class share, you'd be looking at a little bit higher IRR, and then your equity multiple of 2.63. So, really good projected returns there. Can you go to the next slide? So on top of those projected returns I just went over, you also have great tax benefits, right? So we do cost segregation for all our properties. We have an engineer come in and we advance depreciation. So this year you're able to do 80% of that. It's starting to trickle down on the bonus depreciation. But for this deal, we've already had Madison Spec take a look at it, which they do most of our cost seg studies. And what they're projecting is if you were to invest 100,000 on your K1 for this year, you'd be getting around 68 to 78,000 in losses. And then from 110 to 116,000. So your losses would actually be greater than your investment for the life of the deal. So, depending on your tax situation and how much of that you can utilize, I mean, this is definitely a great benefit. I know we use this depreciation quite a bit to help with our taxes on a yearly basis. Next slide. Okay, so coming close to the end here on this presentation, but this is a timeline. So we opened the fund a few weeks back, and the funding is going to be due. So we're taking subscriptions already. If somebody may want to put the link in the chat, somebody can help me with that. If you're ready to move forward, you can click on that link, and we're taking subscriptions. All the paperwork is in our portal. We make it real easy. Brian's going to go through that really quick to show you. So the actual funds will then be due in about 3 weeks from now. And then we are set to close by the end of July. Once we close, then quickly begin to execute the business plan. And then, that'll take about 2 years or so. And then from there, we'll sit pretty and kind of time the market for a great exit for our investors. As I mentioned earlier, right as we sit right now, we're at about 75% subscribed. So if you are interested, I highly suggest you move forward, go to that, click on that link, take a look at the documents. And we do expect this to get filled in the next few weeks, probably the next couple weeks. And with that, I'll leave you with Brian so he can go through some of the specifics on how to move forward.
Yeah, so we opened this up a couple weeks ago. Like George mentioned, we got of the 19 million, we have about 14 and a half committed, or 13 and a half committed. So 75% subscribed already. I think in large part because this is such a nice performing property and how we've underwritten this deal and how we expect to come in and perform here. So after we close, you can expect quarterly distributions after the 6 months of closing, monthly updates on around the 25th of every month, K1s distributed early in the year, and 24/7 access to myself, anyone on the team that you need. So I'll take you guys to our investor portal. I put the link in the chat, so that is where you're going to go. George, if you want to put that in the Facebook chat as well.
Yep.
To the private group. This is the investor portal. So this is where you'll go in and make your investment. You'll see this, okay. Log in. So if you haven't registered before, it'll ask you first name, last name. This is 506C investment. So you do need to be an accredited investor. Right here, that's net worth of $1 million or more, or annual income of 200,000 more. If you're married, 300,000. So I already have an account. As a CIO, I invest personally in every single deal of ours, as a limited partner, not just as a general partner too. So here's what your investor portal will look like. You'll get to see. It's really cool once you start investing, especially in multiple properties here. You can see kind of how your investments are allocated across the portfolio. It'll show you that. Updates on properties will come through here. This is where we'll add distributions. And so for this, you're going to want to go click on Stoney Creek, Rapid City, invest. Right here, we have some more information actually on Rapid City. You can review the investment summary that we talked about today, the PPM. So you'll click next. Class A is for $100,000. Investors, 100,000, 250,000. Class B is for anybody above 500,000 or more. So for here, I'm just going to do 100,000 for you guys. So that puts my reservation in. So this is a three different ways you can verify your accreditation. Parallel Markets is a free website. Then you can copy and paste this. This is a letter that you can actually send to your CPA and verify based on either your income or your net worth. I always try to do parallel investments first because that's free. CPAs, not sure, depending on your CPA, they might charge you by the hour. So this is, you're going to sign the operating agreement and the subscription agreement, incorporating you into the investment. You'll go through here. I'm not going to sign this whole thing, but this is where you'll go through and sign these documents. And that'll save your spot. I'll skip that for now. Here is the funding instructions. This investment is first come, first serve. So first serve on subscriptions. We are already having people, start sending their wires in. We already have the bank account open. So we do encourage you to get your funds in as soon as you're ready. That's kind of the step-by-step process to make your reservations. 2023, pretty cool. You can do this all from here. Don't have to print out anything, all e-sign. You can download all the documents through here. Your bank, you may have to go to your bank to send a wire of this much. And my bank, I go in to it. Some banks, you can do it online. So, I'm excited to get this one closed out here. Again, we're 75% subscribed. So This is a really unique opportunity. It's not one that we come across very often. You know, we're sitting, it's June 22nd, and our last acquisition was in January. So we've made a lot of offers. So, you know, this is our first one of 2023, and I think it's for a reason here too. So.
I think we addressed most of the questions. So if somebody has something that we didn't answer, if they can throw it in there real quick.
Yeah, we got them all. Someone said it's pref compounding. So Eric asked if is pref compounding. The pref equity compounding. That's accrual.
Yeah,
That's
no.
15% a year. So not like a. But in the beginning, we're paying 8%, then it's staggering up. So when we actually got them to come up to 9 million in proceeds at first, that we actually had quite a few different preferred equity partners show a lot of interest. Same with our lenders, and we feel really good about our pref choice here and getting them to come up to 9 million, because that helps the overall return on investment for you as an investor. That's why the equity multiple went up. Also, they won't be participating in depreciation because how their preferred fund is set up. So that's more appreciation to pass on to our investors. It looks like that was the last question. And if you guys have any more questions, reach out to us. It's first name at elevatecig.com. So Brian at elevatecig.com. George at elevatecig.com. Our general email is info@elevatecig.com too. So I'll put that in the chat.
All right. Thank you all for joining us.
Everyone, have a good night.